What's up, guys? I'm Nobody Special, and Federal Reserve Chair Jerome Powell just put the final nail in the coffin of this bear market rally. His speech today at the Jackson Hole Summit was unusually brief for a J. Powell speech, but it was very, very hawkish. I'm going to play it through here and give you my reaction. I'm editing out some of the fluff and getting right to the meat and potatoes of what he had to say, and suffice it to say, he was very hawkish in his speech. Without any further ado, here is Jerome Powell.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth.
Okay, what he's talking about there, using our tools forcefully, what he's talking about is taking a sledgehammer to this economy. His tools are raising interest rates and quantitative tightening, i.e. destroying money. Those are policies that are very restrictive of the economy. So what he's saying, he is going to forcefully use them. He's warning the economy here that this is going to get worse. And he's saying a sustained period of below trend growth. In other words, he's saying we're headed for a big recession. Remember, regardless of what the talking heads in Washington say, the most widely regarded definition of a recession is 2 consecutive quarters of negative economic growth. What he's saying is a sustained period of below trend growth. In other words, they're going to cause a recession. They're doing this on purpose.
Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
When he says softer labor market conditions, folks, understand what he's saying here is destroying jobs. He's going to destroy jobs. He's going to put people out of work, and that's going to hurt people. Jerome Powell is not your friend right now, folks. If you think he is going to swoop in and save the stock market or make sure that we have sustained low unemployment, you got another thing coming. Remember, the problem, as Jerome Powell sees it right now, is there is more demand for labor than there is supply of labor. And when there's more demand than supply, prices go up. Well, when prices go up, i.e. wages go up, that causes, in his opinion, wage spiral inflation. People make more money, so they spend more money. Spending more money creates more demand for goods and services, and inflation gets worse. So Jerome Powell plans to fight inflation by putting people out of work. Most people do not understand this. They don't realize what he's trying to do here. He's trying to kill jobs. He's doing this on purpose. When he says that might cause pain for American households, well, yeah, when mom or dad lose their job, it certainly hurts the household, doesn't it?
The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
So this was a pretty important statement that he just made. He said, while a single month of lower inflation data is encouraging, we're very far from where we need to be. There's a lot of people who saw that lower CPI reading for July and said, there it is, inflation is finally starting to come down. The Fed pivot is right around the corner and they're going to stop raising interest rates. Jerome Powell just said that's not going to happen. 1 month of lower CPI is not enough. This big market rally since that July CPI read, when everybody thought the pivot was just around the corner. No, that's not coming. Jerome Powell is saying we're going to keep tightening. Get used to this. Remember his comments about the labor market and his comments about restrictive policy. He's saying he's going to cause a recession on purpose.
So we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
Policy that will be sufficiently restrictive to return inflation to 2%. He's saying we have the economy in a vice and we are going to keep squeezing until inflation comes down, and he doesn't care what harm that causes people.
At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop.
Again, estimates of longer run neutral, where he's saying we are right now. He's saying the interest rate that the Fed is at, about 2.25%. This is a relatively neutral rate. He's saying we're going higher. Again, the message Jerome Powell is sending the market here is that the Fed pivot is not coming anytime soon. This is very bearish for stocks.
July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases.
So that statement there, at some point it may be appropriate to slow the pace of increases. That's the only thing in this whole speech, in my opinion, that could be interpreted as at least mildly dovish. Everything else was total hawkishness. That one statement there, he's saying, yeah, we're going to keep raising rates, but maybe the rate hikes won't be as severe as they've been over the last few months. Remember, we had 2 consecutive 75 basis point rate hikes. Those rate hikes were unprecedented. They were incredibly high, 2 75 basis point hikes in a row. So what he's forecasting here is, hey, maybe we won't be hiking by as much as 75, but we're going to keep hiking. Whether it's 50 or 25, we're going to keep tightening rates. Again, if you're looking for something dovish to cling to in this speech, this is about the only line of the entire speech that was dovish. Everything else, total hawk.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting.
So he talks about the SEP there. That is the summary of economic projections. That's where they poll all of the Fed governors and they ask them, at the end of next year, what do you expect the Fed funds rate to be at? Right now, the Fed's funds rate is at 2.25%. And according to the SEP, the average of all the Fed governors, they see it at just below 4% at the end of next year, which means 3.75% is the average of where the Fed governors expect to be at the end of 2023. That would be about 150 basis points higher than we are today. So that would indicate a slowing in the pace of raising rates. Now, I have to put an asterisk here because historically speaking, the SEP has been a garbage data point. Remember, this time last year, the Federal Reserve was projecting one rate hike by the end of 2023. Fast forward a year later, and we've already raised rates by 200 basis points. So the summary of economic projections, this is not a binding data point, and historically they have been way off. For all we know, we could be way higher by then, or we could be way lower by then. Do not put too much stake in this SEP that Jerome Powell is talking about.
Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on 3 important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. Our responsibility to deliver price stability is unconditional. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability.
So that's a pretty powerful statement right there. What he said is our tools work principally on affecting the demand side of the equation. And again, when he says his tools, he's talking about raising rates and he's talking about destroying money or quantitative tightening. So he's saying the only thing the Fed can affect is people's demand for goods and services, i.e., we only impact the amount of money that people have. We don't impact the amount of stuff that is available to buy. Nevertheless, he remains fully committed to bringing supply and demand back into line. He remains fully committed to fighting inflation. Now, you need to understand what he's saying here, folks. What he's saying is the only way we can fight inflation is by inflicting economic hardship on the average person, you and me, so that they spend less money or that they have less money to spend. That way, prices might come down because people aren't buying as much. He's moving us around like pawns on a chessboard. He is deliberately inflicting economic harm on the average person in order to get them to slow their spending so the demand for goods and services comes down and the prices come down with it. It's the only way he can fight inflation. He's using this fancy Fed speak to make it sound more gentle when he says, our tools principally work on demand. What he's saying here is that the only thing we can do is hurt people financially so they spend less money. That's what he's going to keep doing. Again, this man is not your friend. He seems nice. He uses big words. He sounds like he's this big academic and, maybe he's really smart. He's got fancy letters after his name. He is not your friend.
There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions.
So what he's warning here is that expectations of inflation have a way of becoming a self-fulfilling prophecy. If people, on average, begin to believe that inflation is here to stay and it's going to keep getting worse, what happens is people tend to start increasing their spending because, hey, I better go out and buy that thing now because next week it's going to be more expensive. So the very fact that people expect prices to go up causes them to pull forward their spending. Well, that increase in spending increases demand for goods and services and causes the prices to go up. You see how this is this feedback loop, this self-reinforcing or self-fulfilling prophecy. And that's what Powell's warning about here. When expectations of inflation become unanchored, if people start to expect higher inflation, they're going to get higher inflation. So what Powell is warning here is the Fed needs to maintain their credibility. They need to make sure people believe the Fed has this under control. Otherwise, all hell is going to break loose. And he's saying, I will do whatever is necessary to convince people that inflation is not going to be a permanent thing.
As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now.
All right, so what he just did here, that was a warning to the economy. Twice there, he evoked Paul Volcker. Paul Volcker had Jerome Powell's job in the late 1970s and early 80s. And when it came to fighting inflation, Paul Volcker was a freaking madman. He raised rates like nobody had ever raised rates in the United States before. I don't know if you can remember, but back in the 1980s, we had like 15% mortgage rates. All right, imagine what your mortgage payment is right now, and you probably have like a 3.5%, maybe a 4% interest rate on your mortgage. Maybe you're lucky enough to have like a 2.5% mortgage rate. What happens if that mortgage rate, what happens to your payment if your mortgage was 15%? You think your house might be worth a little bit less? Do you think you'd be able to afford your house? Heck no. What Jerome Powell is saying right here is, don't make me become Paul Volcker, because I will become Paul Volcker if I have to. If I have to raise rates to 15%, then that's exactly what I'll do to restore price stability to fight this inflation. And folks, we have a $30 trillion national debt in the United States. If interest rates rise to 15%, the United States government will become insolvent. The interest on the debt alone will be more than all tax receipts. So what Jerome Powell is doing right now is he's saying, look, we have to keep tightening here. We have to keep going. We have to stay hawkish. Otherwise, inflation is going to get away from us like it did in the 1970s, and then I'm going to have to pull a Paul Volcker, and nobody wants that. because Paul Volcker took a flamethrower to the economy. He burned everything in order to get inflation under control. It crashed the housing market, it crashed the stock market, and it caused mass unemployment. And Jerome Powell is saying, that's what I'll do if I have to. Don't make me use my Paul Volcker.
These lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
All right, so I'm going to summarize it with this point. Jerome Powell and the Federal Reserve, they created this inflation, along with Congress, along with the supply chain disruptions, right? And of course, the war in the Ukraine, that contributed to inflation, right? But the main driver of this inflation has been all of the money printing that was done after the pandemic. $7 trillion and $8 trillion, whatever, was printed after the pandemic. All that money was dropped into the economy in the form of stimulus, or it went into the asset markets in the form of buying U.S. treasuries and mortgage-backed securities. It's all in circulation now. That increased demand, you give people money, they're going to spend it, and when they spend it, it drives up demands for goods and services. That caused inflation. Federal Reserve created this inflation, and they enriched themselves personally, immensely doing so. Remember, this time last year, we found out that the Federal Reserve, including Jerome Powell, that all those governors had finally sold their stocks in order to eliminate the appearance of a conflict of interest. These guys got rich personally off of this inflation. Then they sold everything at an immense profit, and now they're trying to crank down and to eliminate demand, i.e. to make you poorer in order to fight the inflation that made them rich. And what Jerome Powell just said is, I will inflict as much pain as necessary on the average household to get them to spend less in order to fight inflation, even if I have to go as far as Paul Volcker did in the 1980s. And that is why the stock market is reacting the way it is today. That's why everything is down, because a lot of people in the stock market, a lot of people in FinTwit, a lot of YouTubers have been saying the Fed is about to pivot. Assets are going to go through the roof and hyperinflation is going to hit next month. Nope. Sorry, folks. Jerome Powell just made it painstakingly clear. We are nowhere near done with these rate hikes. Rates are going to keep going up. We are going to inflict harm on the average household until they stop spending. I don't care how many people lose their jobs. I don't care how many businesses go under. I'll do what I have to do to restore price stability. This was the most hawkish I have ever seen Jerome Powell, and that's why stock markets didn't like it today. And if you think I'm kidding about what Jerome Powell plans to do with the job market, you can check out this video I made about how Jerome Powell needs to make sure you do not get a raise. Till next time, live small and dream big.